Supply, supply, supply. We've been consistent on that. There has been improvements on some of the demand settings, but improving demand settings doesn't get more Australians into homes. What does get more Australians into homes is having more homes to move into.
Andrew Irvine, welcome to the business.
Oh, thanks for having me on the show.
The RBA is unlikely to cut interest rates until the middle of next year. Do you think your customers can hold on until then?
Yeah, on the housing side, we've actually seen improvement in household stress over the course of the year. It peaked in the first quarter and has been reducing from there on in. So I think that's positive. Every time in the three instances that we have seen an RBA reduction in interest rates, we've given our customers the option of whether they want to keep their payments at the same level or reduce them to reflect the reduced rate. And 80% of our customers have chosen to keep their payments at the same level so that they're essentially paying off their home loan faster. And 20% who need the help have chosen to reduce their payments. So I think that's reflective of where we are at in the country. Most households are doing well and spending a bit more money, which is driving economic activity. But there is still, on the tail, some stress for those households, and we're there working with them as they manage through things.
We are seeing government subsidies around electricity bills and the tax cuts that we saw, as well as rate cuts, which were boosting disposable income, roll away as we head into 2026. Do you anticipate you might have to offer extra support?
I think hardship numbers are also reducing. So what I would say for anyone who is having a difficult time, give us a call and we'll see how we can best help you. But as I say, I think most Australian households' conditions are improving, which I think is positive for the country.
Well, on that, the RBA, of course, has one technical rate cut penciled in. How do you see Australia's economy performing as we head into 2026, and when do you think the RBA will need to cut rates?
I guess it depends on how things go. We expect the country to show growth of 2% of GDP in 2025, accelerating to 2.3% next year, which is about the level of growth that the economy can handle without generating inflation. We'd all love to see the country be able to grow at something higher, say 3% a year, but to do that we need productivity. And we need more dwellings built that will generate economic activity. We need cheaper and reliable energy. Energy costs are a real problem, as you noted in your question. And then we need to leverage other productivity tools like AI. And if we do those things and do those things well, hopefully the country can grow at a little bit of a faster clip.
The RBA noted in its statement on monetary policy that bank funding conditions are pretty favourable and there's strong competition between lenders. What is the competition environment like?
It's strong and fierce. Home for consumers, lending competition's been fierce for a number of years now, and we're seeing a competition increasing in our core business banking segment as well. Pleasingly, though, our bank grew market share in the year in both deposits and in lending, and we did that while managing margins effectively. So I'm really pleased with how we're threading the needle there for our shareholders as well as for our customers.
We are seeing reports that there could be some stress in the US banking system and tightening credit conditions. Are you seeing that reflected in the wholesale funding that you access?
We are not, thankfully. I think the matter that you highlight is a unique situation to the US economy right now. Thankfully, we haven't seen those translate to us here in Australia. Funding markets are still constructive and we haven't seen an increase in our long-term funding costs.
You said today that housing is Australia's biggest societal and policy challenge. How are we going to solve it?
Supply, supply, supply. We've been consistent on that. There has been improvements on some of the demand settings, but improving demand settings doesn't get more Australians into homes. What does get more Australians into homes is having more homes to move into. So we simply have to build more dwellings. We are seeing some green shoots there. I'd call out South Australia as probably managing that best. They've got 20% increase year over year in housing starts. And we need all states starting to show those types of numbers.
I mean, the government obviously is targeting 1.2 million homes.
Yeah.
We're probably not going to get there, but are we going to get close?
Well, right now, we're not getting there. NAB earlier this month, or just late last month, announced an ambitious goal to help us build more dwellings. We've announced $60 billion of funding, 30 million for demand side and 30 million for supply. So we're really looking at lending to builders and to developers to enable them to build more homes. And what we really need is faster approvals for dwellings. Because time costs money. And we need more labor. We need to be getting more of our young people into TAFE programs to learn construction skills. And we need more migrants with construction skills coming to our shores.
What do you make of the government's first home ownership scheme? Is that going to push up prices in the lower end of the market?
If we have no more supply, yes, which is why supply is so important. I think it's a good policy setting, but if that's the only policy setting that changes, prices will go up and we won't get more young Australian families into homes. The key there is more supply.
And of course, in that segment of the market, we often see investors enter. Are you seeing investor competition between first home buyers and investors?
Yeah, there is competition. We encourage both. You want more investors buying homes because that provides options for renters, and so we want homes for both renters as well as first-time home buyers, and so we're keen to see expansion in both of those areas.
In early September, it was reported NAB was cutting 400 roles from the business. Was that due to AI?
It was not. We're still using AI to make things easier and help our colleagues, but that wasn't due to AI. We're always looking at where we have our staff and what they're doing and looking to improve. That being said, our FTE numbers or employee numbers in Australia are broadly similar to what they would have been in the past. So we're not seeing a net reduction in roles, but the composition of staffing does change from year to year.
On the work from home front, it's still contentious in Australia. What's
Yeah.
NAB's policy and how are you making it happen?
Oh, it's contentious. I think in my working life, it's probably been the most contentious topic. Our view is that hybrid working is here to stay, and it provides us with flexibility for our staff and for our colleagues, as well as the right outcomes for our business and for our customers. And so we're happy with our settings, and we encourage our colleagues to take advantage of them.
Your climate report is out today. The business is working to net zero by 2050. How important is it that the country is on the same page when it comes to our climate goals, given the politicking we're seeing in Canberra?
Yeah, look, Australia needs more energy. We need more renewable energy, and we also need more gas. Gas is very important to provide the baseload power that the country needs, or firming is the language that allows us to have renewables, because renewables go on and off, whether the wind is blowing or the sun is shining. So we need more energy. And that's important for both meeting our climate aspirations and decarbonizing, but also to ensure that Australians have access to cheap, affordable and reliable energy.
And do you think business is on board for net zero 50?
What business want is stability. These things are long-term cycles that require long-term investments, and I think business doesn't appreciate whipsawing of settings. And so let's pick a setting and go for it.
Andrew Irvine, thank you so much.
Thank you.